Welcome to the Deep Dive, where we take your stack of research and turn those complex data points into crystal clear insights. Today, we're plunging into something huge, really. It's one of the most powerful urges in finance. This desire, maybe even this need people feel, to beat the market average. You know what I'm talking about, that deep-seated obsession to get more than the S&P 500's, 8 to 10% annual return, which is already pretty good, right? But it's like this background noise everywhere. You see it constantly. Jim Cramer yelling on TV about his stock picks,
Yeah.
or those premium newsletters promising the secret sauce, you know? And then you've got communities like Wall Street Bets, just pure YOLO energy, people posting these crazy games or, well, devastating losses, too.
Right, trying to catch lightning in a bottle.
Exactly. And it creates this intense atmosphere of confirmation bias. Like, no matter how wild your idea is, you can probably find someone online to agree with you, to tell you you're the one who's going to outsmart the system.
And that's really our mission for this deep dive, looking at the material you provided, including some key analysis from Cash Flow Lab. We want to systematically break down why this chase, this active attempt to beat the market, is, well, statistically, really unlikely to work. And maybe even psychologically destined to fail for almost everyone.
Yeah.
We'll look at the hard data first, and then we'll get into the cognitive biases, the stuff hardwired into our brains that kind of makes us our own worst enemies when it comes to investing.
Okay, let's start with that hard data because, I mean, it's the foundation, right? If the average person with a laptop and a trading app probably can't beat the market, surely the pros can. The ones with the fancy degrees, the huge salaries, the, what are they, $30,000 a year Bloomberg terminals.
Yeah, exactly. Surely they can deliver that alpha, that extra return.
Right.
Well, that's what you'd think. It's logical. But the data, it's pretty startlingly clear, actually. The industry has its own report card. It's called the SPIVA scorecard.
Oh, yeah, I've heard of that. From S&P Global.
That's the one. The same company that runs the S&P 500 index. And this scorecard, it tracks thousands of actively managed mutual funds and compares them directly against their benchmarks, like the S&P 500.
Okay.
And even if you look at short periods, like just 1 year, consistently, more than half of them fail to beat the index. The source material mentioned, I think, the first half 2025 as an example.
Right.
Even in a relatively stable time, 54% of active funds couldn't beat the S&P 500. It's basically a coin flip.
A coin flip you're paying hefty fees for.
Precisely. You're paying a lot for maybe a 50-50 shot, maybe worse.
But, okay, maybe short-term is noisy. What about the long run? That's what really matters for building wealth, right? Maybe they smooth things out over time.
Yeah, you'd hope so. But the answer there is a really resounding no.
Uh-oh.
When you stretch out the timeline, past maybe 3 or 5 years, and look at the truly long-term performance, the failure rate goes from just startling to, well, almost catastrophic.
How catastrophic.
Specifically looking at large cap funds versus the S&P 500. By the 10-year mark, 85.98%, let's call it 86% of these funds, underperformed the index.
Wow. Okay, 86% over 10 years.
And it gets worse. Push that out to 20 years.
Let me guess.
Higher.
Much higher. It hits 91%. Think about that. 9 out of 10.
91%.
These are the sophisticated firms, right? Managing billions, staffed with PhDs, MBAs, using every possible resource, every bit of data they can get.
The $30,000 terminals.
Exactly. And 9 out of 10 of them still can't beat a simple, boring, passively managed index fund that you literally just buy and hold.
That number, 91%, it just completely flips the script, doesn't it? The whole idea that more expertise, more resources, more trading equals better results. It's just not true.
It really isn't. And, Warren Buffett famously put this to the test. He was so sure about active management failing long-term that he made that public $1 million bet.
Oh, yeah, the hedge fund bet. From 2008 to 2017, wasn't it? That's the one. He basically said, okay, pick your best hedge funds, and he put a simple S&P 500 index fund up against a basket of 5 funds of funds chosen by these top hedge fund guys, like the elite of the elite active managers.
Representing the best shot active management had, basically.
Exactly. And the results. Over that decade, Buffett's boring index fund, it compounded at 7.1% per year.
Okay, 7.1%. Not bad for that period, especially with 2008 in there.
Right. And the hand-picked basket of elite hedge funds, they managed just 2.1% a year.
Ouch. 2.1 versus 7.1.
Yeah. The index fund beat the hedge funds every single year except 2008. And even then, the hedge funds just lost slightly less during the crash. It wasn't like they actually won.
So the index fund crushed them. But, okay, this brings up a big question. If the results are this clear, Why are hedge funds and active managers still such a huge business? Why do they keep attracting billions?
Well, that gets us to the sort of financial irony of it all. Active managers and hedge funds can actually do very, very well for themselves financially, even when they're failing their investors.
How does that work?
It's all about the fees, what the source calls the fee trap. Right. Most active funds, especially hedge funds, run on that famous 2 and 20 model.
2 and 20. Okay, break that down.
Sure. It's a 2% management fee they charge every year, just based on the total amount of assets you have with them. And then, on top of that, they take 20% of any profits they generate for you.
Wait, 2% on assets. Let's make that real. If you have, say, $1 million with a hedge fund, you're paying them $20,000 every single year, even if they lose you money, even if the market tanks.
Exactly. Doesn't matter. You pay that $20,000 fee regardless of performance. Now, compare that to a basic index fund like VTI or VOO. What's the expense ratio?
Yeah.
Maybe 0.04%.
Yeah, something tiny like that.
So on that same $1 million portfolio, your annual cost is $400.
Okay, so $20,000 versus $400 every year.
That's a $19,600 difference every year. And that compounds just horribly over 10 or 20 years. Most of the time, that fee hurdle alone is what makes it almost impossible for the active manager to actually beat the cheap index fund after cost.
So they're starting way behind the 8 ball just because of their own fees.
They really are. They have to outperform the market by at least their fee percentage just to break even with the index, which, as we saw, 91% of them fail to do over the long run.
So the high cost of trying to win is basically what guarantees they lose. It's not always a lack of skill, maybe, but just this built-in disadvantage.
That's a huge part of it. And think about this. If the data shows the professionals who are supposed to be irrational and have all the resources can't win, partly because of fees and just the difficulty, what chance does an individual retail investor have? Especially when they're also battling something else.
Their own brain.
Exactly. Their own psychology.
Okay, yeah, let's unpack that. Because if the numbers are so clear, why do we keep trying? Why do individual investors think they can be the exception? And the insight here, like you said, is it's not rational. It's all psychological, these deep biases we have.
Right. We're constantly fighting these powerful cognitive forces. The source material highlights a couple of big ones. First up is something called the disposition effect.
Disposition effect.
It's rooted in really basic human emotion. We absolutely hate the pain of realizing a loss, but we love the feeling of locking in a gain, even a small one.
Okay, yeah, I can see that. How does it mess up investing?
It means we consistently do two things wrong. We sell our winning stocks way too early, we get that little profit, and we get scared it'll disappear, so we sell to lock it in. That's regret avoidance, even if the stock has way more potential upside.
Right. Taking profits too soon.
And conversely, we hold on to our losing stocks for way too long. We just refuse to accept the loss, refuse to admit we were wrong. That's loss aversion. So we hang on, hoping it'll come back to break even as it sinks lower and lower.
Oh man, everyone knows someone like that. Or maybe is someone like that. Bragging about a quick 10% gain on some stock, then you watch it double after they sold. And meanwhile, they've got that other stock they bought 5 years ago. It's down 70%, sitting in their account like a zombie because they just won't sell it.
That is the disposition effect, perfectly illustrated. And studies back this up. It absolutely crushes returns. Those winning stocks people sold early. On average, they went on to beat the market by another 2.4% after being sold. Money left on the table.
Wow.
And the losing stocks people clung to, they kept underperforming by 1% or more. And here's the kicker. Researchers found this behavior gets worse during market crashes. People panic sell their good stuff, the winners, and just dig their heels in on the losers.
Exactly the opposite of what you should do. Buy low, sell high. We do the reverse. Sell low, hold lower.
Pretty much. Our emotions make us terrible market timers. And what's really wild now is how modern trading, especially with social media, takes these individual feelings and blows them up into actual market-moving forces. Forget fundamentals sometimes.
You're talking about GameStop, right? That whole saga in 2021.
Exactly. So the perfect case study. Researchers actually analyzed millions of Reddit comments from Wall Street bets during that time.
What did they find?
They could literally predict the stock's price movements, minute by minute, just by tracking the dominant emotion in the comments.
Seriously? Like how?
Well, in that first massive run-up, the main emotion they detected was joy or excitement. Pure hype. And spikes in joy correlated with the price jumping up in the next 5 minutes. It was this huge self-feeding emotional loop.
Okay, so joy pushes it up. What about when it turned?
Then fear took over.
Right.
Once fear became dominant in the comments, boom, the price would drop significantly within that same hour, people getting scared, getting out.
Makes sense.
But then, interestingly, after it crashed hard and people were weighed down, anger became the dominant emotion. And what did anger do?
Made them buy more. Revenge trading.
Exactly. Anger caused people to double down, buy the dip aggressively, refuse to admit defeat, and that actually caused the price to briefly spike again.
Wow. Joy, then fear, then anger. That's like a playbook for how emotions wreck your portfolio.
It really is. It shows how much modern retail investing can just be driven by pure feeling, not analysis. And yeah, the media loves the one guy who turned 10K into $1 million.
Right.
But the source is clear. For every one of those, there are probably 99 others who jumped in late, got caught up in the emotion, and lost most of their money.
That emotional roller coaster feeds right into the other bias you mentioned, doesn't it?
It does.
Yeah.
It feeds overconfidence. If you survive one of those wild rides, or even if you just think you understand it better than others, you start believing you're smarter than the market.
And if you think you're smarter,
You trade more. You try to time things. You pick individual stocks because you think you know better.
is there data on that? Does more trading equal worse results for individuals?
Oh, absolutely. There's a classic study looked at something like 66,000 brokerage accounts over 5 years. It found that the most active traders, the ones trading the most frequently, the most confident ones, they underperformed the overall market by a massive 6.5% per year.
6.5% worse than just holding the market. Ouch. Why? Just fees.
Fees were part of it for sure. Every trade costs something, even if it's commission-free. But it was also just bad timing and bad picks, driven by that overconfidence. The average household in that study turned over 75% of their portfolio each year.
75% turnover. That's like buying and selling almost everything you own every year.
Yeah, it was 25% more turnover than the market average, just constant churning. And that excessive trading, fueled by thinking they had an edge they didn't actually have, it just systematically killed their returns. Their confidence literally cost them thousands and thousands of dollars over time.
It's so counterintuitive, isn't it? The people trying the hardest, studying charts, making the most moves, they're statistically set up to be the biggest losers, both from fees and from their own psychology tripping them up.
It really is the paradox. Less is often much, much more in investing.
So, okay, we've seen the data on professionals failing. We've seen the psychological traps for individuals. What's the takeaway? What's the good news here for you listening?
Well, the great news is you can actually just stop playing that game.
Yeah.
You can opt out of that stressful, often losing battle entirely and still do really well financially
How?
by remembering the foundational truth. The market itself, long-term, is incredibly resilient. Just look at the S&P 500 over the last 100 years or so.
Yeah.
It lived through the Great Depression, World War II, the crazy inflation of the 70s, the dot-com bust, 2008 COVID. I mean, disaster after disaster.
Right.
And through all of that, the overall market trend has been consistently up. It's delivered wealth to patient investors, hitting that rough 10% average annual return over the very long term.
Patience being the key word there.
Absolutely. And the strategy to capture that is just beautifully simple. If the pros with their huge fee disadvantage fail 91% of the time, your goal shouldn't be to be them. It should be to simply match the index they're failing to beat, but do it way, way cheaper.
So index funds.
Exactly. Buy a low-cost, broad market index fund. Something like VTI, which tracked the whole U.S. stock market, or VOO for the S&P 500. And then, and this is the hard part for some people, just set it and forget it.
Set it and forget it. Easier said than done when the market's going crazy.
It is, but that's the discipline. For people who want a bit more diversification, maybe a simple 3-fund portfolio, a U.S. index, an international index, and a bond index fund. Still super simple, still super low cost.
And the low cost is crucial, right? That 0.04% expense ratio versus the 2%.
That's your massive advantage. You're removing that anchor that drags down the active funds. So instead of spending hours trying to pick the next Tesla or stressing about market timing,
which we've established probably won't work anyway.
Right. Your energy is so much better spent on optimizing things you can control. Like making sure you're maxing out your Roth IRA or 401k contributions, getting money into those tax-advantaged accounts first, or maybe diversifying into completely different areas if appropriate, like, I don't know, certain commodities or real estate, things not directly tied to stocks.
Okay, so focus on the bigger picture, the allocation, the savings rate, not the individual stock picks.
Precisely. And, the source did mention, if you absolutely must own individual stocks because you enjoy it or believe in a few specific companies, limit it. Keep it to a very small part of your portfolio, maybe inside a retirement account where taxes are deferred, and focus on truly great companies you understand and want to hold for the long haul. Don't trade them actively.
Right. Treat it like speculation, not your core strategy. And maybe the biggest benefit isn't even financial.
You mean the peace of mind?
Yeah. The more simple and automated you make this, the better, right? You get back all those hours you might have spent watching stock tickers or stressing over CNBC headlines. You don't have to ride that emotional roller coaster of GameStop mania or worry about the disposition effect biting you.
Absolutely. Less stress, more time.
And here's the amazing paradox we keep coming back to. By choosing the most boring, hands-off, do-nothing strategy, you are statistically likely to end up with better returns than 90% of the people who are actively trying to be clever and outsmart the market.
It's incredible, isn't it? You essentially profit from other people's mistakes. Their panic selling during crashes, their overconfident buying near tops, their constant churning that generates fees, their inability to overcome those high costs we talked about.
So the best investors are often the most boring ones.
Usually, the most disciplined, the most patient. Focus your main energy on earning more in your career or business, automate your savings into these low-cost index funds, and just let the market work for you over decades.
Okay, so let's try and wrap this up. What's the core lesson here?
I think to reiterate, really, the hard data shows even the pros with all the resources struggle immensely and largely fail to beat their benchmarks long term. And for individuals, our own built-in psychology, things like the disposition effect and overconfidence, make active trading almost a guaranteed way to underperform.
This is the smarter path.
The smarter, more disciplined, and frankly, less stressful strategy is just patient, automated, low-cost index investing. Let compounding do the heavy lifting.
Okay. And we talked earlier about how powerful emotions, joy, fear, anger can actually be in driving stock prices, like with GameStop. Billions of dollars moving based on feelings. So here's a final thought for you, the listener, to chew on. By choosing this passive, index-based strategy, by deciding to stay detached and rational, how does that disciplined choice actually position you? Does it make you, in a way, an economic counterforce? Someone who actually benefits from the mania and the psychological errors that drive so much of the market frenzy? Something to think
It's
about.
definitely something to think about.
Thank you for joining us for this deep dive into why beating the market is harder than it looks and why maybe you don't need to try. If you found this analysis helpful, please do subscribe or follow wherever you get your podcasts for more insights. We'll see you next time.